The limited partners are those partners whose liabilities are actually limited to the amount of capital they contributed, meaning that in the event the partnership is unable to pay the debts for that particular partnership form of a business, their personal properties cannot be taken to pay the business debts. So the maximum they can lose is the amount of capital they contributed in starting that particular partnership and nothing more than that. So for a partnership also to run, there must be at least one partner whose liability is general. All the partners cannot have their liabilities limited. At least one partner must have his or her liability being general, and that is the person who is going to be liable in any event the partnership is unable to pay the debts. Then partnerships can also be classified on the basis of duration or period they are going to be in operation. And there we have got the partnership which are temporary. Temporary partnerships are those partnerships which are established for a particular purpose only. And the moment that purpose has been accomplished, that particular partnership ceases to exist. Like, for example, there can be a partnership whereby people have come together to construct a house, whereby now we can have those who are the mercenaries, those who are maybe the electricians and the plumbers, who come together with the sole intention of having a house being built. The moment the house has been fully completed, then that particular partnership is going to be dissolved, and such kind of a partnership is known as a temporary partner. But we have those which are permanent, whose existence is actually infinite. We don't know when it's going to stop. Then we have, according to activities, partnerships can either be trading or non-trading. The trading partners are those that are involved in buying and selling of goods. The non-trading partnerships are those that deals with the offering of services. We can have a partnership of the lawyers, the partnership of accountants, auditors, and such kind of a form of businesses. Such are known as the non-trading partnerships. So those are the broad categories of partnership as a form of business organization. Then we have got the types of partners. Remember, the partnership is the business, partners are the owners. The partnerships, we have got these partners who can form them. We have got those partners who are active. At the same time, we have got those partners who are dormant. An active partner is the one that has the responsibility of running the partnership in its day-to-day operations. The partner is going to open and shut the business in the evening. That particular partner is known as active. He takes the mandate of running the partnership. Then we have got those partners we call the dormant. They just contribute the capital and they will never be seen in managing the partnership business. They only wait for the end of the year, then they get their share of profit, but they have contributed capital in that particular partnership. Then we have got those partners whose liabilities are going to be either general or limited. We have talked about the two terms. The general, you can lose your personal properties. The limited, you cannot lose anything above the capital that you contributed. On terms of ages, we have got the partners we call the major and the others we call the minor. A major partner is a partner who has attained the age of 18 years. A minor partner is a partner who has not attained the age of 18 years. On the basis of capital contribution, we have the partners we call real and those that we call the guasi. The real are those partners who have actually contributed capital. They have actually contributed capital, and that is what made them to be the partner in that particular partnership. But then we have got those we call the guasi. The guasi, they are those partners who have not contributed capital, but they have allowed their name to be used in the partnership because of their prominence. Because of their prominence, people will feel like if that particular person is a partner in that particular business, then that is a very serious partnership. And then they are going to have a positive, kind of water, people are going to perceive that particular partnership being very okay because of the involvement of those people we have referred here as the prominent people. So those people who have not contributed capital, but they are among the list of the partners, those partners are known as the quasi partners. Then we have the other classification like the secret partner, the partner who is actually not known. And then we have the retiring partner, the partner who is now moving out, either because of one reason or the other. He does not want to remain in the partnership form of business, he's moving out. And then we have got the incoming partners, those partners who are being admitted into the partnership as the business goes on. Then the next area is on the format of a partnership. We have talked about that. My intention is on for any partner or partnership to start, there must be a document. There must be a document which is going to guide the owners on how that particular partnership is going to run. Remember, this is an association of 2 or more people. And whenever we have got 2 or more people coming together, then there must be something like a constitution that is going to guide them. How are we going to handle this kind of a case? How are we going to share the profit? How are we going to admit new partners and all that? So there's that document that is going to outline all those. That particular document is normally known as the partnership deed or the partnership agreement. It is a partnership deed or a partnership agreement. And that particular document, as I've said, it is going to outline how the partners are going to relate with each other. Like for example, we have got the name and address of the business, name and address of the partners, the purpose of that particular partners, the amount of money the partners are going to be allowed to make as drawings from the partners, from the partnership, the interest the partners are going to be charged on that particular drawings, if capital is going to attract any interest, and that interest is going to be of how much. All those are going to be contained in what we call the partnership deed or the partnership agreement. So the partnership agreement is actually an agreement between the partners themselves on how they are going to run that particular partnership business. But in the event there is no partnership agreement or partnership deed, what normally comes into effect is what we call the Partnership Act, which is actually an act of parliament. And in that particular act, because you failed to agree and come up with the partnership agreement, the partnership deed, or sorry, the Partnership Act is going to see all the partners being equal. And then it is going to suggest that every partner should be treated equally. In terms of capital contribution, everybody should contribute equal amount of capital. Profit should be shared equally. Nobody is going to be given the salary. There is no drawings, no interest on capital, and all that. But that is when you don't come with your own agreement as a partnership. So if you have your own partnership agreement, then the Partnership Act will not be used. But if you fail to come up with a partnership agreement, then the partnership deed automatically takes control. So that is what I have just talked about, the Partnership Act. And then we have got now the accounts that are going to be maintained by the partnership, and that's where we are going to dwell for the rest of this particular topic. So let us go back to maybe the blackboard, and then we talk about now the partnership accounts that are going to be maintained. So the partnership, partnership accounts. As we have said, it is an association of 2 or more people. And because they are two or more, and they are coming together to form a business, and the sole aim of a business is to make the profit, obviously, we are going to have the sharing. We are going to have the sharing of profit or losses. In case the business has incurred some losses, we are going to have the sharing of losses. So the additional part of the partnership accounts, when you compare it with the sole traders, is that we are going to have this part of the sharing of profit. Remember, a sole trader, once you have generated the profit, the entire profit is yours. If you have incurred losses, the entire loss will belong to you. And you need to find out how you are going to return back that money into the business. So the additional part that we are going to witness here, after you have arrived at the net profit, what next? After you have arrived at the net profit, you are going to proceed and do what we call appropriation. You are going to proceed and do the appropriation. And appropriation now shows how the money that has been generated as the net profit here is going to be shared among the partners. But before we go here, allow me to mention some few things here on the drawings. One is on the drawings. We know drawings, it is when the business resources have been taken by the owner for their own personal use. You take the resources of the business for your own personal use, then automatically that is going to be drawings. The partnership, they normally allow their partners or the owners to take money for their own use, but they take it for their own use and then they are going to return it back to the business at a later date. And as they take these drawings for their own use, they are going to return that money with what we call the interest. So we are going to have what we call the interest on drawings. We are going to witness what we call the interest on drawings. This interest on drawings, it becomes an income to the partnership. It becomes income to the partnership. If you have taken 10,000, then you are going to return maybe 12,000. The 2,000 is going to be the interest on the drawings, and that 2,000 is going to be treated as an income, and it is going to be added. We normally add this to the net profit. We normally add this interest on drawings to the net profit as an additional income to that particular partnership form of business. Another thing that we are going to witness here is what we normally refer as the interest on capital. We normally have what we call the interest on capital. Interest on capital here, it is going to be the partnership, which is the business, paying the partners. It is the partnership paying the partners as a reward to the partners for having sacrificed that amount of money we call capital, and they brought it into the partnership. So at the end of the year, the partnership will be paying the owners a token, which we are referring it as the interest on capital. But I want you to note that the interest on capital, it is now the business paying the partners. But the interest on drawings, it is the partners bringing it to the business, and that's why we are considering this as an income. So this one is going to be as a pay.
Mwalimu.
Yes.
Question.
Yes.
Is interest on capital same as dividends?
No. In a company we call it dividends. In a company we call it dividends, but now in a partnership we normally just call it as interest on capital. When we proceed to the company accounts, we shall refer it as dividends. But in partnership we just call it the interest on capital, but it is more or less the same thing. It is more or less the same thing. Are we together?
Yes.
Okay. So dividends, they are only going to be applicable in the company accounts. But here we normally use the interest on capital. So interest on capital, it is going to be an income to the partners, but not an income to the business. To the business is a payment, but to the partners who are the owners is an income to them. So we are going to see also how we are going to to draw that. So what is going to be extra when you compare it with the sole trader is these two accounts that we are going to prepare. Here, number one, we are going to prepare what we call the appropriation account. We are going to prepare the appropriation account, which is just a continuation from the point we get the net profit. After getting the net profit, we normally proceed and prepare the appropriation part, which is just an extension of that. So after we have arrived at the net profit, a certain amount of money, to that we normally add interest on drawings. We normally add to that interest on drawings. So we have a partner A, the interest the person is going to pay. Maybe we have a partner B, also the interest the person is going to pay. We add them, we get a certain figure here, which we shall add to the net profit to get a figure there. So the interest on the drawings is normally added to the net profit. After adding it like that, we now come here and less interest on capital. Remember, this is now a payment from the business. What partner A is going to get, you put there. What partner B is going to get, you put there. You add, you get a total there. Remember, that is a deduction, you put it into bracket. You also less the salary to partners. Maybe it is partner A who is entitled to salary. The salary to partner, remember, it is normally paid to the active partner. Remember, when we are talking about the categories of partners, we said that we have got the active partner and the dormant partner. The active partner is the one that takes the responsibility of running the partnership. At the end of the day, the partner is going to be entitled to a certain amount of money, which we normally call the salary. That one is a payment when we talk about it from the side of the partnership. So it is the partnership paying the partner. You put that amount there. Then we are also going to talk about what? Sometimes the partners might give loan to the partnership. Apart from drawings, remember drawings is when they take money from the partnership for their own use. But sometimes the partners can bring additional money to the partnership in the form of a loan. Loan from partners. Interest.
Malima, please adjust the board.
Sorry?
Please adjust the blackboard. You can see below.
Okay. Let me adjust my camera. Interest on loan from partners. Maybe it is partner B who has given the loan to the partnership, you less, like that. So that now, this total income, the income from the net profit plus the income from the interest on drawings, we got that, and now we less this. You will get now the balance. You will get the balance like that. That balance now is what the partners are going to share in accordance to the profit sharing ratio the partnership has provided. So first of all, let me just go up a bit. You have got the net profit from the trading of the business. Then you add now what the partners are supposed to pay back to the partner, to the partnership in form of interest on drawings. You add it there so that now you can get the total income that is available in the partnership. That total income now, you raise what the partnership rather is going to give to the partnership, to the partner. The partnership is going to give to the partners. Remember, the partnership is the business. This is the total income the partnership has generated. And now we give now to the partners what is due to them. in form of interest on capital, less from that. So from that income again, we are going to pay the salary of the active partner, we less it. We are going to pay the interest on any partner's loan, less. Now, whatever is going to remain after we have done these deductions is what the partners are going to share. So this figure, we normally call it balance to be shared in profit sharing ratio. In profit sharing ratio, that figure here. It is the balance to be shared in profit sharing ratio. So there, you will come here and you find what partner A is entitled to get and what partner B is entitled to get in form of profit. So A will get a certain ratio, you put the figure there, B. So whatever A plus B will get, you put that total there. If you minus what was available for them to share and what they have shared, you will find that at the end of the day here, you will find a nil balance. You will find a nil balance there. Actually, they are going to share everything. This is what was available to be shared, and that is what they have shared. So there is nothing that is going to remain after they have shared the profit. And this is what we call the appropriation account. Getting the net profit, add the interest on drawings, then you less this. Remember this, the interest on capital, salary to partner, the loan or interest on loan, and the balance on the profit sharing ratio. All this is what now the partnership is going to pay the partnership. The partnership is going to pay the partners. Sorry, I'm confusing the two words. The partnership is going to pay the partners. Interest on capital, salary, interest on loan from a partner, and the profit share. All this, it is the partnership paying the partners who are the owners. And now, if they have shared everything, then balance here is going to be nil. The balance is going to appear as nil. That is the appropriation account. The other account that we are going to prepare here, and very common, it is what we call the current account. The current account. The partners current accounts. It is just a T account with the debit side. Sorry, this is the credit side and the debit side. Like that. It is just a T account, not a complicated account. So on the credit side, I want you to get it clearly. We normally record what the partners are going to get from the partnership. It is like what they are going to benefit from that particular partnership. Their benefits, the partners benefit from the partnership. And here we are going to record what? Remember, we have got partner A and partner B. So what they are going to benefit from the partnership is going to be what? Number one, we have got the interest on capital. That is a benefit they are going to get from the partnership. You put here what A is entitled to get, and for B, you put the figure B is entitled to get. Another benefit they are going to get is the salary. Salary to partner. In this case, we said partner A was enjoying a salary. You put if it was A, the other one does not have. The other thing is interest on loan. Interest on loan. This one, we said B to get the interest on loan because it was B who had given the loan. And then we also have what we call the share of profit. This is what they are going to benefit from that particular partnership. That is going to be the benefits they are going to get from the partnership. Then on the debit side, you are going to record what now the partners are going to pay the partnership, right? What the partners owe the partnership. And here we have got still A and D. We have partner A and D. And what are these things? Number one is the drawings. Remember, the partners had taken the business money for their own use, so they owe the partnership that amount of money. You record here what A had taken and what B had taken. The other thing that they are going to owe the business is going to be the interest on drawings. Interest on drawings, the interest that has accrued from that amount of drawings. So these two is what the partners owe the partnership. And this is what the partnership owes the partners. So this is going to be the benefit they are supposed to receive. This one they are supposed to pay the partnership. So that is the opposite. And then now you are going to balance them. Balance carried down. You put the figure for this, the figure for this. And how do you get the balance? You just total this minus the total for A. The total for A on the credit side minus the total for A on the debit side, it will give you the balance, so that the total for A on this side and the total for A on this side, it is going to be the same. So the figure here and the figure here should be the same. You do the same to B. You add the totals here, you minus the totals here, you get this balance. You get this balance, so that the figure for B on this side and the figure for B on this side, they are going to be the same. Don't forgetting that in most questions, you will have the opening balance. You will have the balance brought down from the previous period. You start with it at the top, and now you record that. The partner's current account is normally prepared after you have prepared the appropriation. So it is just lifting these figures, the ones that you got on the appropriation, now you bring it here. These balances, this balance carried down, these figures, they are going to be used in the statement of financial position, and we are going to add them to capital. We are going to add them to capital. So you note that we cannot go to the statement of financial position before we prepare the partner's current account for us to get this particular balance. So up to that point, I want us now to put whatever I have said into application. I want us to start with the number 3 of the questions that I shared. Number 3. I want us actually to prepare the appropriation so that I can show you how appropriation is done. And then we prepare the current accounts for the partners. If you are told to prepare the appropriation account, you will start by the heading. This is Salim and Job partnership. Appropriation account. For the year ended, that first deck, just underline that. We just underline that. Then you locate the profit for the year. It is under Roman 3. The net earnings for the year ended 31st December 2018 was 1,400,000 shillings. So that is the net profit or net earnings. 1,400,000. That is the net earnings. To that, we said we are supposed to add interest on drawings. We are supposed to add the interest on drawings. And remember here we have got two people. We have got Salim. Let me just put it here, Salim. And we have got the interest on drawings from Job. So we need to calculate that. Look at the last item or the last information given as number 7. Drawings during the year amounted to Salim 2.4, Job 1.7. Those were the drawings that were made in that particular year. And then you combine that information with the number 4. You combine that information with the entry number 4. The partners agreed to charge interest on drawings at the rate of 8% per annum. Interest on drawings is charged at 8% per annum. So for Salim, the interest will be how much? It is going to be 8% times the drawings for Salim. Salim had taken how much in terms of drawings? 2.4. So you calculate 8% of 2.4. Then for Job, it is going to be the same 8% times the drawings for Job, which is 1,700,000. So for Salim, if somebody has done that, you can give me the figure. 8%. 8% is 0.08 times 2.4.
192,000.
Okay, we have 192,000. For Job, %.
136,000.
Sorry?
136.
136,000. So can you add the two of them? 192 plus 136.
328,000.
328,000. Remember, we have said this interest on the drawings is an income to the partnership. So we normally add it now to the net profit so that we can get the total income that is available. From trading, we got net profit and this one. So this one is going to be 1,728,000. That is what is available. That 1,728,000, it is going to be used to pay the interest on capital. It is going to be used in paying the interest on capital. We need to know how much Salim will get and how much Job will get. Then the same statement number 4 says that, and to pay interest on capital at the rate of 10%. So Salim is supposed to get 10% times the capital, because it is interest on capital. You multiply the capital Salim had contributed, and the capital account at the top there, Salim was 12 millions. You get that. For the other person, Job, you also get 10% times the capital Job contributed, which is 9 millions. So this one will be what? 120,000.
1.2 million.
1.2, sorry. 1,200,000. This one would be 900,000. So combined, they give you a figure of 2.1. 2,100,000. That is the total interest on capital. And remember, this one we are supposed to less. Also less, just right here, less. We also less. Let us look at it. Let us see number 4. 4 we have taken care of. Number 5, the monthly salary for each partner was 150 and 120 for Salim and Job respectively. So we have got a salary to partners. Salaries to partners, Salim, and the other person is Job. But now, the salaries that we have been given here, they are per month. They are monthly salaries. And this particular appropriation is for the entire year. So whenever the salary is given per month, so it is your responsibility to make it annual. You multiply by 12 so that we can get the total salary the whole year. So for Salim, it was given as 400,000. You multiply by 12. And then for, sorry?
Mwalimu,
Okay,
the salary is 150.
Okay.
150, Mwalimu.
Yes, I've seen it actually. Yeah? I was using for the room. Eh? The other partner is 120, yeah? Times 12. You make it annual. So 150 times 12.
$1.8.
1,800,000.
Then 1440.
So total comes to
3.24.
3.24. That is another payment. Then what else do we have? Number 6. Loan taken by each partner during the year was Salim 400,000 and Job 1 million. No interest on loan was to be charged. So that one we don't actually capture it here. But if there was interest, we could have added there. And then lastly is the drawings. So we needed to know how much is going to remain or how much loss are they going to have for sharing. There is nothing else that we are going to put there. Number 6, you just ignore that. Just ignore that.
Mwalimu, on the salaries, if it's not indicated that one partner is active and the other one was just contributing, then we'll have just introduced the salary for one of the partners and not both.
Yes.
At what point are you able to tell that you are paying the active partner and the dormant one?
Actually, it is going to tell you. The question must tell you. It will just tell you that Salim was being paid a salary of 1.8 M, and the other one is not mentioned. So you just know that it was Salim who was active. You just put the figure on Salim. Actually, they will tell you the partner who is entitled to salary, if not both of them. So it is going to be so straightforward. They cannot pay to give you. Is it okay?
Excuse me,
Yeah. Yes.
Why are we ignoring point number 6? Why are we ignoring point?
Number 6 says that the loan taken by each partner during the year was Salim, that and the other one. And now the other part, which is on the interest, no interest on the loan was to be charged. Remember, if there was interest that was charged on that particular loan, that interest could have come here. We could have added that interest to the net profit because it's going to be an income. It is going to be an income. But the loan itself, the amount for the loan itself is not an income. Is not an income. Even if it was not taken, it is going to be maybe in the business. As actually, it is not an income. What we normally consider as the income is only the interest. Is only the interest. So we normally argue that if that amount was not taken as the loan, it is going to be in the business and it is not going to have any effect here. And because that money is going to be returned, the effect is not going to be felt in the business performance. But that interest could have been an income. But the loan itself is not an income and it's not actually a payment. Are we together?
Mwalimu, please expound on the loan.
Yes, are you through? Are you through with the question?
Sorry, Mwalimu, I don't know, maybe it's on my end, but I seem to be losing you. I just need clarity on the loan. When you say loan from partners, it means it's the partners loaning the business, or now the statement says loan taken by each partner. So the partners can actually also use capital to take loan.
Yes.
When do we less?
So let me explain it this way. Whenever, anyway, loan can be two-way. Eh? It can be the loan given to the business by the partners, or it can be the loan taken by the partners from the business. Eh? So if it is like in this case, it's actually loan taken by each partner. So it was taken from the business by the partners. So they are supposed to return that amount of money. So that loan, if it has interest attached to it, that interest is going to be an income to the partner, to the partnership. The interest, if you pay and you pay plus the interest, so you have returned the money back plus the interest. So the interest will be added to the net profit. Interest on loan is going to be added to the net profit because it is an income to the partnership. But if it is the loan given by the partners to the partnership, then the partnership, which is the business, it is supposed to return the money back to the partner plus interest. So that interest will have been deducted here. So if it is interest from money given to the partners, it is going to be an income, because if we put ourselves in the shoes of the business, if we have given somebody a loan and he pays with the interest, that interest is an income to us. So it is going to be added to the net profit. But if somebody has given us the loan and we are supposed to pay that particular person with plus interest, then it is like an expenditure to us. That interest is going to be deducted. It's going to be deducted. So in this case, the statement is clear that there was no interest that was charged on that loan that was taken by the partners.
So it's supposed to be deducted from the net profit.
If it was if it was attracting the interest,
Yes.
it was actually going to come among these. No, it is going to be added. If it is interest taken by the partners or the loan taken by the partner and that loan is attracting interest, you add it. You add it. The same way we have added to the interest on drawings. Why have we added the interest on drawings? Because
it's an income.
It's an income, yeah.
The same case, if it is an interest from the loan the partners had taken, just a minute, let me power this. If the partnership had given the partners a loan and those partners are paying plus interest, that interest is going to be an income and it should be added here. But if it is now the other way, the partners giving the business the loan, it is going to be an expenditure and we less it. So you must know, is it loan given by the partnership or the loan given to the partnership by the partners? So if it is the loan given, it is going to attract an interest, which is a payment. But if it is a loan, if it is a loan given to partners, it is going to attract interest. That interest is an income you add. If it is a loan received, that loan received is going to attract interest, which we need to pay, and therefore it becomes a payment less. Okay. But the amount itself, the loan amount itself does not come here. Does not come on the appropriation. That amount that was borrowed does not come here. So in the appropriation, we normally deal with the interests only. Interest only. Interest received add here. Interest paid you less, as we are lessing the others. So can we get now the figure that we are going to share with the partners? The partners are going to share a figure of how much, and is it positive or a negative figure? This 1.728, you less this and this. And actually it is like it's going to be a loss. So we can write here share of, or let me put it as balance of loss. Loss balance to be shared. It is coming how much? 1.728 minus the other figures.
Um, 3 million
3.6.
3 millions?
612,000.
612.
612,000. Okay, that is what they are going to share. And remember, this is a loss. This is a loss that they are going to share because the figure that they had as an income is this, and this is what they were supposed to pay each and every partner. And therefore, they are going to witness a loss. And how are we going to have it now? So, share of losses, we have the share of Salim and the share of Job. And if you look at the statement number two rather, statement number 2 says that profit and loss sharing ratio is accordance with the capital contributed by each partner. So they are going to share them in accordance of the profit, the capital. Remember the capital for Salim was 12 millions. The other one is 9 millions. So they are going to share it in that ratio. So you just simplify, cancel 5 zeros. This is 6 zeros like that. 9 is to 12. We can simplify this by 3, 4, by 3, 3. So in short, the ratio is 4:3. The ratio is 4:3. If you are told in the capital contribution ratio, you just put the capital contributed by this is to the capital contributed by the other, and then you simplify as much as possible. You find that the ratio is 4:3. Now, how much will Salim actually share? Salim, the ratio for Salim is 4. Remember, we said it's 4:3. Yeah? You normally add 4 plus 3, you get what? 7. So everybody will get over 7. So this one will be 4/7. 4/7 times that loss. The other one is going to get 3/7 of that loss. So 4/7 times this, 3/7 times that. Do you have for Salim?
Yeah, 2
2,000,000.
2064.
Yes.
206.
2,064,000.
Okay. The other one will get.
Is 1.548,000.
Come again, sorry,
1,548.
Yes. 1,000.
Yeah.
Okay. But if you add this plus this, you will get this figure. Yeah? So this minus this, actually you are going to get nil. That minus that, you get the figure at the end of the day is going to be nil. The figure becomes nil. So having done that, now we can go to the current account, what the question was asking. Let me project it. The partner's current account. We have got Salim. Salim and Job. The same case here, we are going to have like that. So whenever you are told to prepare the partner's current account, you start with the opening balances of the current account. Number one, you are told the current account for Salim and Job. So those figures, they have not been given, or whether they are on the debit or credit. If you are not told, they will always appear on the credit. So under normal circumstances, the current account is supposed to have a credit balance. It is supposed to have a credit balance. But sometimes you can have the partner having a debit balance, and that one will be indicated. But if the question does not indicate, just know the balance is a credit balance, and you put it them on the credit balance. So you are going to start with the balance brought down. For the current account, Salim is 6,550,000. 6,550,000. For the other partner, Job is 3,700,000. Like that. Then from there, as we said, on the credit side, it is what the partners are going to benefit from the partnership. Right? What they are going to benefit from the partnership. And they are all this, what we are saying, less. So number one, we have got interest on capital. The first one is interest on capital. Interest on capital, we had computed. The first partner was getting 1,200,000, Sarim. The other one was getting, the other one was getting 900,000, like that. Another benefit was salary. Salary, and in this case, we calculated, we found this one was to get 1,800,000. The other one was to get 1,040,000. Now this share, now it is not going to be a benefit. Whenever the loss has been incurred in a business, that loss simply means that the partners are supposed to give back to the business. This is not the business to give them. It is them to give that money back to the business so that the business can be in a position to continue trading. So loss, it is a payment. So on this side, we are going to consider that particular loss. It is not a benefit to the partners. They are not benefiting. It is going to cost them. They are going to pay that amount back to the partnership. So here we shall start with, we normally start with the drawings. And here you put the entire amount that was taken for personal use. The drawings, which is additional number 7, it is 2,400,000 for Sarim. And the other person is 1,700,000. Remember, we said on the debit, it is what the partners will be paying the partnership business. So number one, what they are going to pay, it is the drawings amount that they had taken. Number two, they are going to pay the interest on drawings. That is number two. They are going to pay the interest on drawings, and that one we had computed here. The interest on drawings. This one, Salim was to get 192,000. Was to pay, sorry, and the other one was to pay 136,000 on the drawings that they had made. Then the other thing that they are going to pay back to the business, it is the loan. The loan in this case is how much? That is what we were skipping. Number 4, number 6. Starting 400,000. The other partner took a loan of 1 million. Like that. So that is now your current account, and now your responsibility is to just balance it. So you just compare, like for example, job on this side and job on this side. So if you add the figure for job on the credit side and the figure for job on the debit side, we need to get the difference, and that difference is going to be our balance carried down. So you are getting a total of how much here?
I think it's 40,000.
This one?
Yeah.
40,000. What about on the debit side, the same job?
2836.
Sorry?
2,836,000.
So this one is having more, eh? The credit side is having more. We write 40,000. So what is the balance that is going to make them balance? The figure that is going to make them balance. Remember here we have got 60-40, here we have 28-36. We need to insert a figure here so that they can be the same. That is our balance carried down.
3204.
Like that. We go now again to Salim. We get the total for the credit and the total for the debit.
50,000.
50,000. On the debit side?
92,000.
92,000. So this has more. We put that figure here. And here is supposed to be the same. The balancing figure is the balance carried down. So 9550 minus 2592. $95.50 minus $25.92, you get?
$69,58,000.
And that is the end of that. If we were to do the statement of financial position, these figures we shall have added to the statement of financial positions capital. That is the end. Let us now look at a very comprehensive question where we are going to go all the process from the beginning to the end. And I want us to use which question, as we also do some revision on
Question 1, I think has all the three.
as all the three.
Does the income statement, partners, current accounts, and the statement of financial position.
Okay, let me power on the lights. We start. So in that question 1, we are told that Rachel and Violet are in partnership trading under the name Rabbit Traders. The following is the partnership trial balance as at that 1st March 2018. So the trial balance is there. And now we are given the additional information. As we all know, whenever you are given a problem of this nature, to solve it, always go to the additional information and get or do the workings. We need to do the workings or an adjustment. Number one is inventory as at 31st. Remember that 1st March is the same date we are preparing the statements down there. So that is the closing date of the financial year, and the stock or inventory you are given there is the closing inventory, which is given as I want you also to look at the trial balance. If you look at your trial balance at the top there, you are told that the figures are in shillings and in thousands. The figures are in shillings and in thousands. So the figures that we have under the additional information, we should also omit 3 zeros, because even the figures in the trial balance, the 3 zeros are not there. So if you are told that this one is 120 millions, so if it was to be put in the trial balance, it would appear as 120,000. So you just omit 3 zeros like that, so that the figures can be uniform. Number 2 is allowance. Allowance for doubtful debts is to be provided at the rate of 2% of the outstanding trade receivables at the end of the year. So we are told that it should be calculated as 2.5 over 100 times the receivables, times the receivables. The receivables is the same as the debtors. So can you locate the receivables so that we can compute the 2.5%? We have got the trade receivables and trade payables, 9,200,000. So we calculate this one on 9,200,000, 9,200,000 like that, and 200. This one will give you a figure of how much? 2.5 times 92. Somebody, so that we can finish.
230.
Sorry?
230.
30. The moment you have calculated the allowance for doubtful debt, the other responsibility that you have is to find out whether you have got allowance for doubtful debts in the trial balance. Do we have allowance for doubtful debts in the trial balance? I can't locate any. I can't locate any. So if there is no allowance for doubtful debts in the trial balance, then the whole amount is going to be considered as an increase. The whole amount to that is going to be considered as an increase, because we assume that it was initially 0. So there was no allowance, but now it has been increased to 30. So it has increased from 0 to 230. The whole amount is going to be considered as an increase. But if there was allowance, we could have actually determined the increase or the decrease. We compare this figure with the figure given there, so that we can find whether this one has gone up compared to that or gone down compared to the same figure. But if it is not given, we take the whole amount as increase. Number 3 is on depreciation. And the assets we have here, number 1, we have got the buildings, and the depreciation is 2.5 over 100. It is your responsibility now to look at the method of calculating depreciation. And in this case, we are told that it is 2.5 on cost, 2.5 on cost. So you go to the building and pick the cost of that building. You can be able to see it. It is written building at cost 30,000. So you calculate 2.5 on 30,000. How much do you get from that?
$750.
1150.
Yeah.
Okay, we go to the other one, which is the depreciation on motor vehicle. On motor vehicle, we are told that the depreciation is 15 over 100, also on cost. If you are told is on cost, just multiply by the cost of the motor vehicle. Go to the trial balance, find the motor vehicle at cost. It is given as 18,000. So you just do 15% of 18,000.
2,700.
2,700.
Mwalimu,
Go to the last fixed asset that is depreciating, which is fixed costs and fittings. And in this case, now you are told that the depreciation is 10%, but now the method is not cost, it is on reducing balance. When the depreciation is on reducing balance method, if you can relate with the end year adjustment, with the reducing balance method, we normally calculate depreciation on the net book value. We normally calculate the depreciation on the net book value and not the cost. So,
Sorry, Mwalimu, the building is 750, not 1150.
yes,
750. Come again, Abraham.
750, I think.
yes, it's 750.
Okay, thank you. Now we are at the fixtures and fittings. If it is on reducing balance, and I want you maybe to get it clear here, if it is on reducing balance or you are told it's on the net book value, you cannot calculate it on cost. You need to get the value of that asset as at the beginning of this year. And it is very simple. For you to get the net book value, you simply take the cost of the fixtures and fittings as given. Fixtures and fittings, you are told they are having a cost of 4,200. Then always remember to minus their provision for depreciation. Always remember to minus their provision for depreciation, which is 1,250. That is when you get. So the cost minus the provision. Remember, in our last class, I told you the provision for depreciation is the depreciation of that asset from when they were acquired up to the beginning of this financial year. Up to the beginning of this financial year. So we normally subtract that depreciation so that now we can get the value of these assets when we started this year, and that value is our net book value as at the start of the financial year. So remember always to subtract the cost minus the provision for depreciation if depreciation is calculated on a reducing balance, but in some questions they can tell you it is calculated on book value. If it is book value, it is the same as on reducing balance method. So you will get 4,200 minus 1,250, and then whatever you get, you multiply by 10%.
295. 295.
295, huh? And that is how we are going to do it. So there is a difference when it is on cost and on reducing balance. Then we go to number 4. The partnership deed has the following agreements. 1, Violet to receive salary of 3 million per annum. So we have this salary to Violet. Automatically, this is the active partner. 3,000. Remember, we are omitting 3 zeros everywhere. Interest be charged on drawings at the rate of 10%. This is number 4. Let me call this one number 5. Interest on drawings is to be calculated at the rate of 10%. So you need to calculate for Rachel. It is going to be 10 over 100. You multiply by the drawing amount for Rachel. The drawings amount for Rachel is 3,600. You get this one is going to be equal to what? 360. That one gives you 360 for Rachel. Then for Violet, is going to be 10 over 100 times the drawings amount for Violet, 4,200. You calculate this one, you will get 420. 20. Then we go to the next agreement, that interest be allowed on capital. Number 6 is interest on capital. Then Rachel will get how much? The interest on capital is at the rate of 5%. Rachel will get 5 over 100 times the capital Rachel contributed. Rachel contributed 25,000. So interest on capital, you multiply by the capital amount, you find that this one is going to be what? 1150.
1250.
1250. For Violet, she will get 5 over 100 times the capital she contributed. Violet's capital is 20,000.
1,000.
1,000. We are through with all the workings. Now we can go to the statements comfortably, and we pick those figures whenever we shall be requiring them. So number 1, we are supposed to do the statement, the income statement. The income statement. The procedure does not change when we compare with the sole trader. It only has an addition of the appropriation, but the procedure is exactly the same. So this particular partnership, we are told that it is operating under the name Ravi. So we can say Ravi Traders. Income statement for the year ended 31st March 2018. So we said once you are there, you need to consider whether you will require 3 columns or 2 columns. And what will dictate 3 or 2, it is whether we need to do an adjustment on the purchases. Does purchases require any adjustment in form of carriage inwards and return outwards, or purchases returns? Do we have any of those from the trial balance? Do we have carriage inwards or purchases returns? I don't see any, so 2 columns will be enough for us. So just come here and say we need that. Remember, our figures are going to be in thousands. You just put those 3 zeros there. Then we shall start with the sales as usual. We are given down there purchases and sales. Purchases is always going to be having a debit balance. So when they are combined like that, purchases and sales, just know the figure on the debit is for purchases and the figure on the credit is for sales, because even from the regions we know that purchases is always debited, sales is always credited. So sales is the credit figure 7808. Then we have sales returns. Don't think, I can't see sales returns or return inwards. It is not there. So that is going to be our net sales. If that is the case, we come here and we say less cost of sales. Underline that. Start with the opening. opening inventory. That is the inventory on 1st April 2017. Remember we said opening inventory is going to be found on the trial balance. And I think the figure is 7,000, put it here. Then you say add purchases. You add the figure for the purchases, which is 39,300. Because we don't have any adjustment to capital, we add it direct 00364. 46,300. This is the cost of goods available. Cost of goods available for sale. 46,300. The cost of goods available for sale. 46,300. Then from that, what is available, we less the closing. We less the closing inventory. Under the additional information number 1, we were told it was amounted to 120,000. Huh? Just a minute. Is it really 120? It is very high compared to this. Huh? Was that figure 120,000? Let me confirm somewhere.
It was on 20 million.
Millions. Huh? If we are with the 3 zeros, huh?
Yeah.
Inakuja 120,000. And
yes.
This one is 46. What was available is 46. I don't think whether it is making any sense. Eh?
Yeah.
With what was available is 146. There is no way the closing can be. The closing cannot be more than what was available. Eh? I think it was supposed to be 12 million so that it can be 12,000. Eh? Let us use 12,000. We cannot use 120 millions, 120,000. And I think that one was a mistake from the examiner. If we less 12,000,
that would be
34,300.
34,300.
Let me put it here. 34,300. That is now what we call the cost of sales. So this is the cost of sales. This is the sales. So it costed us 34,300 for the goods that we sold 78,808. So the difference between that will give us the gross profit of how much? 508. That is 36,508. You are not wrong. That is the gross profit figure. So the gross profit, you need to know whether we have got any income, any other incomes. Other incomes, we said the incomes are normally found on the credit side. The incomes are normally found on the credit side. So you look at those figures and find out whether we have got discount received, whether we have got commission received, rent received, and interest received, and actually decrease in provision for doubtful debts. So you look at the credit side to find out whether we have got rent received, discount received, commission received, interest received, those 4, plus the decrease in provision for doubtful debts. The figures that are appearing on the credit, there is none. Actually, there is none that qualifies to.
Yeah, there's none.
None. So this is going to be our income. Then we come here, we say less expenses. The expenses for the business. From the workings that we did there, we have got allowance for doubtful debts. And remember, it's supposed to be captured as increase in allowance for doubtful debts. The increase is 230. Depreciation, and here we have got towards buildings, 750. Towards motor vehicle, 2,700. Towards fixtures, 295. Then this, remember this one, whatever that is in the partnership deed, the salary to partners, the interest on the drawing, the interest on capital, those are not expenses. Don't mistake them and bring them here. Whatever is entitled to the partner will only be used in the appropriation. So you just reserve them. Let us pick the other expenses from the trial balance.
Salaries, there are salaries.
Salaries to other workers.
Wages, salaries and wages.
Okay, salaries and wages. How much are they?
6,700.
6,700. We have got the bad debts. I can be able to see it adjacent to that. The bad debts written off, 185. We go up, we have got office expenses. $570. We go up, discount allowed. Discount allowed is allow me, it is 340.
340.
340. And actually we have got interest. It's an expense. Interest on loan. $570. I want us to confirm something. Remember, down there, we are told we have got 12%. 12% bank loan. 12% bank loan, and it gave 7,000. The bank loan is 7,000 and it was 12%. This 12% is meant to calculate the interest. So if you do 12% of this, are you getting the same figure that we have there? Is it the same as 5? What are you getting there? If you do 12% of 7,000.
Yes.
It's coming to
840.
840, okay. Then it is okay. Then it is okay. Distribution expenses. Like 20. Then you go up. Do we have, I can't see any other expense. Can't see any other expense. So can you add for me those expenses?
13,530.
13,530. This is the expenses. That one will give you the net profit. If you subtract from this, you subtract from this, the gross profit. So the net profit is how much? 36,508 minus that. Is it going to be 22?
22,978.
Yes.
22,978. That is our net profit. The moment you have arrived at the net profit now, that is where the appropriation starts from. That is where now the appropriation will start from. The appropriation will start by, we add the interest on drawings. That is where now the appropriation is going to start from the net profit downwards. So we have got the interest on drawings. We had done the computations here. I'm just lifting. The Rachel was to pay an interest of 360, and Violet was to pay an interest of 420. So the two combined, they are supposed to pay interest of 780. They are supposed to pay the interest of 780. You add that to that particular net profit. It is an income, so we add it to the net profit. How much will that give you?
23,758.
23,758. Then we less now what goes to the partners as benefits. Remember, this is from this income, we should pay what now the partners are demanding from the partnership. So we shall rest what? One, we have the interest on capital. Let me put it so that it does not seem as if we less interest on capital for Rachel is supposed to enjoy the interest on capital of 1250. For Violet, the interest on capital is 1,000. So the two combined, they are supposed to be paid 2250. They are supposed to be paid 2250 from that. Then we have got salary too. We also less salary to Violet, which is 3,000. We less it. What else are we going to less? From the partnership agreement, I don't think there's any.
Interest on loan, is that coming somewhere?
This
adjust your board.
okay.
Oh yeah, it's already up there. It's already under the expenses, so we don't have it there done again.
This loan, this was a loan from a bank. This is not a loan from a partner. What we normally use here is the loan from partners, or loan
Yes.
given by the partner. But if it is from a bank, you don't put it here on appropriation. Here on appropriation, we deal with the items touching on the partners only. So I don't think we have got other deduction that is going to be made from that total income. So can we get the balance that is going to be shared now on the profit and loss sharing ratio?
Mwalimu,
Yes.
how come this salary you have put it on the middle, on the last column?
Oh, this
and the other salaries and wages were on the first column.
This one. Okay, we have got salaries here. Remember the salaries that are under the expenses here. These salaries are to those people who are working in the partnership, but they are not partners. These are the salaries and wages to the outsider. But the salary to Violet, Violet is one of the owner of this particular partnership. This goes to the appropriation. Remember, we have said from this portion downwards, it's appropriation. And here we only capture with the items talking about the partners, either income to the partners or what the partners are supposed to pay the partnership. So the salary for Violet, it is not under this because these are the outsiders. But for the partners, their salary is supposed to be captured as a payment on their appropriation. On their appropriation. And because the other person who is Rachel, there is no need of putting it here. We normally put in the middle so that we can add them. Like here, because there are two, we put them, you add, you transfer the total there. You put them, the two of them, you transfer the total. So because the 3,000 does not have a partner to be added to, we just put the figure directly there because Rachel is not enjoying any salary. So it was just a single figure. There's no need of putting it here and then we transfer there. Have I answered you, Doctor?
Yes, thank you.
Okay, we are looking at the balance.
The balance is 18,508.
18,508. That is balance to be shared. Balance to be shared in profit and loss sharing ratio. So we need now to know what is the ratio of sharing. What is the ratio of sharing? So we need to get the share of the first partner, which is Rachel. What is the share of Rachel and what is the share of Violet? That is what is going to remain. So how are they going to share it? So we need to go to the profit sharing ratio, which is the last item. Rachel and Violet are to share profit and losses in the ratio of 5:2. So whenever you are given that ratio 5:2, you need first of all to add them. 5 plus 2, you get 7. So each one will be getting over 7. Each one will be getting, yes?
I think I've seen it's 3:2.
Oh, 3:2. Okay. I don't know where I got 5. It is 3:2. So the total here is going to be 3 plus 2, which gives us what? 5. So everybody will be getting over 5. So for Rachel, it is 3/5. So this one will get 3/5 times 18,508 of this amount. The other person, Violet, will get 2/5 times 18,508. Do the working for me.
For Rachel, it's 11,105.
11,105. For Violet,
Seven 7,403.
4 or 3. So if you add that, they should give you 18,508. And now, if you do the subtraction, you will get here it's going to be. So they will share everything and there will be no balance. There will be no balance.
Mwalimu, I have a question.
Yes.
For instance, when you're doing the percentages of each and you get maybe some decimals,
Yes.
should we indicate the decimals or we round them off to the nearest figure?
You use 2 decimals. You use 2 decimal places because they normally say money it is normally to the nearest. Actually, those are the cents.
Yeah.
Yes, just use 2 decimal places, but rarely will you get, but if you get that, just use 2 decimal places.
Okay.
This
Alimu, I have a question. So where?
Sorry, one person first.
The fraction of Rachel
Yes.
is
3
5 over what?
3/5.
3/5. Okay.
One is 2/5. The ratio was 2:3. 3:2. The 3 for Rachel, you divide by the sum of the ratio, which is 5. 3/5. The other one is 2/5. You multiply by 18,508.
Alimu, I have a question. I'm not sure if I missed. Where did we leave out the doubtful debts? Because we put the bad debts and the expenses. Where is the doubt? Okay, all right.
The doubtful debt is, have you seen what
Yeah.
allowance for doubtful debts to that, yeah?
Yes, okay. I thought we left it out, okay.
So that is how the income statement, and actually it is the income statement and appropriation, because it is having that. So you can be able to see the appropriation is simply this part, and that is what we did on the first question. We did it from here to here. But you can combine them. You can combine them. After getting the net profit, you just proceed. The only thing I want maybe to remind you, when it comes to the salaries, the salary to a partner, don't include it here. It is not an expense. And the salary to other employees, it is not going to come here. So you need to know how to separate them. Salaries to employees is an expense. Salary to the partner, it will go to the appropriation.
Mwalimu,
Once you have done that, you can proceed and prepare the partner's current account. The partner's current account, I want to use just the middle part that we have drawn this.
Mwalimu, I think Abraham is talking and there's a problem. It's like you cannot hear him.
Yes, Abraham.
thank you, Daktari, for mentioning my name. Yeah, I was asking, is this question, we spent almost over 1 hour. Can it come in this whole whatever, or in parts?
You see, if you look at the question number 2, the question that I've captured there as number 2, it is actually, I think it was for 2018, CHRP.
Yeah.
And it can come actually as the compulsory question. You know, you have the compulsory questions.
Yeah.
So it is a question that you must be conversant with. And actually, as I said, it is very rare for you to miss the financial statements. If they don't give you for the sole trader, if they don't give you for the sole, sorry. I was saying that you need to know how to do it. You need to know how to do it. So I know it is a bit lengthy, but when you are doing it alone, it cannot be time consuming as when we are doing all of us. So let us go to the current account. I hope you have noted the share of profit. Have you written it down? Because we shall need it somewhere. Abraham.
Yes, we have.
Okay. So let us go to the current account. We need that figure. So the partners here are, let me just use R for Rachel and B for Violet. No, there's a reflection on my screen. Let me try to push it downwards. Come out of that reflection. So for the current accounts, what we need to start with is the opening balances. If you look at the question or the trial balance, there is the current account. There is the current account, and those figures are the opening balances. So we need to come here and record them. But you can see one of them is appearing on the debit and the other one is appearing on the credit. For Rachel, it is a credit of 424. But for Violet, it's a debit of 127. So we should capture them like that. So we come here and we write balance brought down. For Violet, it is not on the credit side, just put a dash. For Rachel, it is 424 credit because it's appearing on the credit side of the trial balance. Then you come and also do the same here, balance brought down. For Violet, it is appearing on the debit, you put it as 127, and the other one you can put a dash like that. So if it is on the debit, put it on the debit. If it is on the credit, put it on the credit. But if the question does not give you the debit and the credit and it is silent, put all of them on the credit. Put all of them on the credit. So what you will do now, we said on the credit is what the partners are going to enjoy from the partnership. Number one, we have got interest. Let me just use I capital. Interest on capital. You just go to the workings. We had the interest on capital for Rachel was 360. For Violet was 420. That is the interest on capital. Then the salary to Violet.
Mwalimu, that is interest on drawings.
Yeah.
Oh. Okay, thank you for reminding me. For capital is what? 1250, yeah? Yes, 1250 and the other one 1,000. Thank you. Thank you. Then another benefit the partners are going to get is the salary. Entitled to salary here, and that partner is Violet, getting a salary of 3,000. The other partner does not have any salary, you put dash. The other benefit is going to be the share of profit. The share of profit. I don't have that figure. Remind me, for Violet it was?
Violet was 7,403.
7,403. For Rachel?
11,105.
Okay, those are the benefits they are going to get from the partnership. Then we come here, we write now what the partnership demands the partners to pay the business. Number one, we have got the drawings, the whole amount. It should be paid back. The drawings for Rachel is 3,600. The drawings for Violet is 4,200. Like that. Then they should also pay the interest on drawings. The interest on drawings, 360 for Rachel, and for 20 for Violet. I think that is all that we need to record in the current account. That is all that we need to record in the current account. And you can be able to know that these figures are what we normally use in the appropriation account apart from the drawings. The entire amount for drawings does not get used in the current, in the appropriation. But the others, you will just pick them from the appropriation account. But don't forget to include the drawings when you come here and the opening balances. After doing the posting, now we can calculate the closing balances. We can calculate the closing balances. So we need to add on the credit side, Violet, we start with maybe Rachel. Rachel has got a total of how much?
12,779.
12,779. What figure are we going to add it here so that it can balance? Because obviously this has less.
8819.
8819. That is what we call the balance carried down. We do the same to Violet. The total for Violet on the credit side is going to be 1143.
1143, correct.
Yes, and this side is also going, it is supposed to be 11403. Yeah? This one is 12779. So what figure are we going to put here as the balance so that the total can be the same as what we have on the credit?
6656.
56?
6656.
56. Done. If that is done, sasa si tunaenda kwa statement ya mwisho, which is the statement of financial position. So what I want you to note down as we proceed to the statement of financial position, we shall use this. Have these figures with you, and then we proceed there and finish. So this is Ravi Traders. Statement of financial position. As at. Remember, the statement of financial position should be dated as at that particular day, and this is 31st March 2018. As at 31st March 2018. So as usual, we need to start with the fixed assets. We start with the costs. Accumulated depreciation. Net book value. We need those three columns, and then we can start by recording those fixed assets. Number one, just a minute. If you look at the trial balance, there is land. If you look at the trial balance, there is land. Land at cost 12,000, and it does not depreciate, so you start with it. We have land of 12,000, not depreciating. Its value at the end of the year will still be 12,000. Number two, we have got the buildings. The buildings, their cost is captured as 30,000. Then you need to be very careful on the depreciation. You confirm, do we have a provision for depreciation on buildings? There is 6,000. 6,000 is what is given there. And remember, in our adjustment, let me just go there. In our adjustment here, we had the depreciation for building as 750. This 750 is only for this year. This only for this year. We add the 6,000 for the previous years. We add the 6,000 for the previous year so that we can get the total depreciation, and which will be 6,750. So if you subtract 30,000 minus 6,750, is it 23,250? Confirm for me whether I'm doing it right. 30,000 minus 67.
Yes, it is 23,250.
Okay, then we go to the next fixed asset, which is motor vehicle. Motor vehicle, whose cost is 18,000. On depreciation, you must also be careful whether we have got the provision for depreciation. So the motor vehicle at cost, that provision for depreciation on motor vehicle, we have 4,500. So 4,500 is for the other years, the previous years. Then we add this one for this year, 4,500 plus 2,700. You get it is going to be
7,200.
Sorry?
7,200.
Exactly. So if we less 7,200 from 18,000,
10,800.
10,800. Exactly. The other fixed asset is the fixtures and fittings. Fixtures and fittings. Their cost is 4,200. Their accumulated depreciation, don't forget to incorporate the figure for provision for depreciation on fixtures, 1,250. And this time we had 295. 295 plus 450. 295 plus 1,250, sorry. 295, 1,250.
1,545.
1,545. If you less 1,545 plus from 4,200.
2,655.
2,655. Right now. So remember, for the depreciation and the costs, those columns we don't need. We don't need them anymore. We just need to get the total for the net book value. Just add for me. You are getting
48,705.
48,705. Huh? We go to the section of the current assets. We have the receivables. The receivables, always remember, we must deduct the allowance for doubtful debts. We must deduct that because the 230 for allowance for doubtful debts, it is not guaranteed that you are going to receive it. So, and it is going to reduce the receivables. The receivables are the debtors. So the debtors figure was 9,200 minus 230, so that now we can get the figure that is actually expected to be received, which is going to be 8970. That is what we are sure to receive. Then we have got the inventory. In this case, we said we use the closing inventory under the additional information, and we made an adjustment to that. We said it must be an error. That figure should be 12,000, not 120. The next one is, if you look at your trial balance, anything else that qualifies to be called a current asset is just cash. Cash in hand, 1,400. Because we did not have the prepayments here. We did not have the prepayments here in this question. Can you add that? The total current assets is giving a figure of how much?
22,370.
22,370. Add that one to the net book value, 48,705, so that we can get the total assets.
$71,075.
Those are the total assets. Then we go to the section of capital and liabilities. Capital and liabilities. What do we have in that section for capital and liabilities? We start with the capital. And the capital here, because it is partnership, it is going to be contributed by the partners. So we need to know the amount contributed by Rachel and the amount contributed by Violet. That is the capital accounts. You just go and pick the figures. Capital accounts for Rachel, 25,000. For Violet, it is 20,000. For Violet, it is 20,000. So the total capital here is going to be 45,000. The total capital is 45,000. We also now include the current accounts. That is where we now include the current account balances for Rachel and Violet. Remind me the current account balances that we have arrived at. For Rachel, the current account, the one that we have written as balance carried down, it was 88.
For Rachel, it was 8819.
8819. For Violet,
6656.
6656. The two combined, the balances is how much? 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656. 6656.
15,475.
15,475. Then we go to this part of because we have got the bank loan. Bank loan is normally considered as a long-term liability. It's normally considered as a long-term liability.
Mwalimu, what is under capital? There is a reflection there.
Capital here.
After capital, yes, there.
This is current account. Current accounts.
Okay.
Current accounts. So bank loan is normally considered a long-term liability, and the figure or the amount we got from that, remember it was a 12% bank loan. The figure that we got, or the amount of loan that we got, is 7,000, and this one we need to pay. Then we go to the section of current liabilities. Current liabilities, if you look at the question, the liabilities are always on the credit. You just go down on the credit side.
On the long.
Sorry? Sorry, come on.
Please explain the long-term liability.
Long-term liability is a liability. Remember, first of all, liability is a debt. A debt that is going to be paid after a period exceeding 1 year, 1 financial year. That is a long-term liability. A liability that we are going to pay as a business after 1 financial year. So you can find that it is a debt that we are supposed to pay after 5 years, after 4 years, after 10 years. So long as it is beyond 1 financial year, it is a long-term liability. So in a sole trader and the partnership, the bank loans, they qualify to be known as the long-term liability, because this is a liability. You find that this loan is supposed to be paid after 3 years or 5 years, and this 12% is the interest on that, and this interest is normally annual. Okay.
Thank you.
So, Malema, why are we not taking the whole loan amount?
The whole
loan amount.
We have taken the whole loan amount.
Oh, okay, the 7K. Okay, thanks.
The 580 or 540, that one was the interest. It comes as an expense, but this whole amount is a liability. So the last item, the current liabilities, the ones that we have, if I look at the trial balance, remember liabilities, capital, and the incomes, they are normally on the credit side. If you look at those figures, the only current liability that is there is the trade payables of that 600. The trade payables. The others are just the provision for depreciation, the capital, the current accounts. They are not liability. So we have got the trade payables, and it is of that 600. So can you include it there and try to sum? Include it and try to sum the figure for capital, current account, and the others to see whether we are going to have the same figure as the total assets.
Actually the same.
They are coming to 71.
0.75.
That is the total for capital and liabilities. So it should actually tally with this.
Mwalimu,
Yes.
such a question carries how many marks?
20.
They should make it 50.
A whole 50 marks.
Too long.
Yeah. It is quite actually detailed. But you can be able to see we have got a very minimal deviation from the sole trader. It is only the part of the appropriation, the part of the current account, and then this current account will come here to be included as an amount for capital. Remember, for the sole trader, we normally bring the net profit or the net loss. But now for the partnership, that particular net loss is going to be shared. And once it has been shared, it is going to be used in preparing the current account. So we only bring here the balance for the current account. But if it was for the sole trader, we only add here the net profit or the net loss we subtract. But here, that particular profit is going to be used in preparing the current account. So the balance of the current account is what we bring here. And it is what we call the partnership account. So I want you now to try the second question. The second question is on 3 partners. The procedure is the same. The procedure is the same. Try it and then we shall see. But my intention is tomorrow we go to the company accounts. We go to the company accounts and then we see what is the addition that we are going to find there when we compare with the partnership and the sole trader. The company is the most complex form of business organization. And then we need to know how the accounts are prepared. But again, you'll find that it's going to share a lot from what we know already. It is only that we shall remove the appropriation and the current account and then add something small on the sole trader, and then it is okay. So the sole trader, it is actually going to save you. If you know that particular format, these others are just few additions and few subtraction. So any question up to that point? Okay, if there's none, we can stop there for today. Thank you for coming on board. We'll meet again tomorrow as we move closer to finishing what we are supposed to learn, and then find maybe 2 or so classes for revision, and then we shall be done. Thank you very much.
So we
Thank
shall
you,
have something to
Thank you, Mwalimu.
tomorrow's lesson.
Sorry, Daktari?
We will have something else for questions for tomorrow's lesson.
I will share very early. I will share very early.
Okay.
Yes, I know we cannot do more than 2. We only need 2 because of maybe the details they contain. They are a bit lengthy, the same as this. So I will just prepare the 2. I take you through the same, and then you shall raise any question if there will be any. But for today, that is enough. I wish you a blessed evening.
You too, Mwalimu. Thank you.
Thank you, Mwalimu.